I'm Safie Russell from SDR Consulting Inc., and we're here today on Business Basics Friday. The goal of this session is to provide some value to small business owners in the space of tax, accounting, and general business, and then have an open Q&A at the end.
Happy Friday, everyone. Happy Friday. Hope all is well with you. Welcome. Happy New Year if you haven't joined us since the new year. I hope you had a great week and welcome again. So if you're here live, go ahead and share in the comments below, or if you're here on Clubhouse, share in the chat where you're joining in from. I'm from New York. It is currently 42 degrees, still a pretty mild winter, fingers crossed. Hope the same for you, and I hope you're safe. And so once again, if you're here live on Facebook, go ahead and share in the comments where you're joining in from. So we're going to go ahead and get started. Welcome to Business Basics Friday. I'm Safie Russell, founder and CEO of SDR Consulting Inc. Business Basics Friday is a weekly session catered to providing valuable information to business owners. We have a variety of guest speakers to come in and share information that can help educate you on the many areas of your business or practice that you need to manage. And as a disclosure, this is strictly for education and information purposes only. No client relationship is being established, no specific advice for your situation, and we're not liable for the use of any information provided today. But you can definitely set up a consultation if you like. As far as my background, I've been in the industry 20 plus years. I'm a CPA and enrolled agent and have a master's in taxation. SDR Consulting Inc. is a virtual firm based in New York, but we do service clients all over the US. And we mostly work with business owners, especially mental health professionals, helping you reduce your concerns regarding tax and accounting so you can focus on your clients and your own well-being. And so today, if you do have questions and comments, go ahead and put them in the Facebook comment section or in the Clubhouse chat area, and we will definitely be able to go over them at the end. So once again, I want to thank you for joining us today. And today we have our guest speaker, Alex Casella, who's going to be covering upcoming changes to retirement planning. So stay tuned. Alex, the floor is yours.
Thank you, Safie. It won't allow me to share my video. Here we go.
There we go. Perfect. Thanks again. There you go.
Thanks for that warm introduction. Hello, everybody. My name's Alex Casella. I'm going to go ahead and share my screen while I'm chatting here. And I'm calling in from Connecticut. And it's bright and sunny today, mid 40s, pretty mild. Like Safie was saying, we haven't had a whole lot of snow this year. So anyway, let's jump right in to the retirement planning. To also give a disclosure, like Safie was saying, today is purely educational. This is not a specific sales recommendation or specific sales presentation. If you do want specific advice, it's always best to talk to somebody with a financial background to get feedback about your personal situation. A quick background about me: I've been working in the financial services industry for 14 years now. Along the way, one of the things that I've noticed is that individuals who are working in healthcare, individuals who are mental health professionals, individuals who are first responders, while you're going through your professional training, you're not really getting a lot of education in personal finance. So I saw this as an opportunity to educate people. So a big part of our practice focuses on comprehensive, holistic financial planning. What does that mean? It means we cover all areas of finance. We don't just focus on one area. And the basis for our practice is education. When we work with our clients, we educate them on the things we're doing, because at the end of the day, we want to make sure that they understand what these decisions are. So we focus a lot of time on education. With that, to support what I was just saying about financial literacy, here's some data that backs that up. This is from 2018. It has been updated. We just haven't had a chance to update this slide yet. But what we know is that, there's a low rate of financial literacy. We know about 80% of people have debt. Majority of them feel like they have too much. Most people don't have emergency funds. Financial literacy is lacking. We know that there's some financial behaviors that need to be improved. And we know a lot of people, more than 50% of people, feel anxious about their money. So it's a source of stress and anxiety. So again, back to that education component, by educating people and walking them through those financial decisions can ultimately help to reduce some of that stress out there in the world. So for today, we're going to be talking about retirement planning. We're going to talk about why it's important, different types of retirement accounts, just to kind of set the basis for retirement planning, and then also to talk about the Secure Act, which goes over changes to retirement plans that were put into law recently. So why is retirement planning important? Well, there's a number of reasons, but these are pretty much the top ones. There's a lot of uncertainty surrounding Social Security. The most recent reporting from Social Security says it can sustain itself through the year 2035, which means by 2035, there's a possibility that it may not be able to sustain itself. So that means we have about another 12 years left to go with Social Security. Of course, things can change. Since I've been in the business, one of the observations I can make is that it's something we've been talking about for a while. So it does change from time to time. There's a possibility it can last longer. There's a possibility it can last less, or maybe it stays at the same prediction. So there's uncertainty surrounding Social Security. So that means it's on us to provide for our own retirements. We don't want to work for the rest of our lives. We don't want to place burden on our family, right? We want to make sure our family doesn't become the financial backing for our retirement. Healthcare costs are predicted to continue to rise. There's inflation in purchasing power, something we've been experiencing over the past year. Things will continue to rise. Planned obsolescence in technology, which is a fancy way of saying that things will continue to improve. Technology continues to improve, and we have to continue to update things. I mean, we're on the iPhone 14 right now. We're on Windows 11. We have to update our cars. We have to upgrade things from time to time, and those things cost money, and that will happen in retirement. For some, retirement is far away. For others, it's kind of around the corner. So it's really important to sit down, no matter what part of your career you're in, and just to take a look at what you're doing for retirement planning to make sure you're taking the right steps toward retirement. Here's a very small example of why retirement planning is important. If you take a small contribution every week, right, and you do that for a 12-month period, we're not considering any type of growth on this money. We're literally just taking money and we're, in a sense, sticking it under the mattress. If you were to take $20 a week and put it away for 52 weeks, you would get $1,040 at the end of that period. On the other side of that spectrum, if you did $150 a week, right, you did that for 52 weeks, you would save $7,800 over that period. So a small dollar amount every week does add up to a larger amount over time. And then when we start to talk about growing that money, right? So if we want to take a look at putting interest on that money, what we're going to focus on is compounding interest to compare that against what's known as simple interest. Simple interest is interest just on a principal dollar amount. So we're going to use $10,000 as an example. If you were to get 7%, we're going to use a hypothetical 7% over a 12-month period. With simple interest, you would get $700 of interest on $10,000. If we use compounding interest, which is interest on interest, meaning every time I get an interest payment, that next period will also get that interest, right? It'll get applied to that interest. At the end of that 12-month period, with that same $10,000, assuming hypothetical 7%, we would be able to get $723, right? So you're getting more interest using compounding interest. And to show you what that looks like on a more amplified basis, if you will, on a longer basis, we can take a look at 3 individuals who save money over a period of time, right? In this example, we have John, Jane, and Bill, right? And all 3 of those individuals are saving $100 per month. John is going to be working for 32 years. He's 33 years old. Jane is 30 years old, is going to be working for 35 years. And Bill is age 22, is going to work for 43 years. That brings all these individuals to the age of 65, which is the, more or less the average retirement age. It's a year we use for a target, maybe not necessarily everybody's retirement age. But if we use that as a target, what we know about John is he's going to be saving for 32 years. If he did $100 a month for 384 months, which is 32 years, he will save $38,400. On the other side of that, if we look at Bill, who's going to save for 43 years, that same dollar amount, he's going to have $51,600. So if you're going to compare John with 38,000 and Bill with 51,000, you're talking about a $13,000 difference between the two, right? Not a whole lot of money in comparison to one another. But now when you add on that growth component, you add on that hypothetical 7% rate of return we're talking about. And we compound that over those years. When we look at when John is at age 65, he's going to have $143,000. When we take a look at Bill, who's saving for 11 years more, he's going to have $329,000, right? What does that tell us? Well, it tells us that compounding interest is a very powerful thing, but it also lets us know that if John being the person who's going to get to age 65 first, if John were to put away $200 per month, right, he doubles the amount he's putting in, he's still going to have less money than what Bill would have. He would have about $287,000 if he doubled the amount that he was contributing, right? So compounding interest is super important. And one of the reasons why you want to get started earlier, because the earlier you start, the more of that compounding interest you can take with you throughout your career or your lifetime. The different types of retirement accounts, right? So when we start talking about the different types, it's important to start looking at the taxation, right? How the taxes are treated, right? We're going to talk about income, we're going to talk about contributions, and we're going to talk about distributions, right? So there's two main types of retirement accounts. You have traditional retirement accounts and you have Roth retirement accounts. What are the differences? Again, the taxes. On a traditional retirement account, you're going to put money in on a pre-tax basis, meaning you're going to take a tax deduction on the contribution amount that you put in. That money will then be taxed when you use it in retirement. So you'll take taxable income from a traditional retirement account when you start using it. So if we take an example of $50,000, if somebody earns $50,000 a year, they contribute $5,000 to a traditional retirement account. That means they'll only pay taxes on $45,000 that year because they're taking a deduction for the $5,000 that was contributed to a traditional retirement account. When they go use that money again in retirement, now it's going to be taxed. The opposite of that is the Roth retirement account, which uses post-tax contributions, meaning you're not getting a tax deduction. When you go use that money then in retirement, it'll be tax-free income at that point. So that same example, $50,000 salary, contribute $5,000 to a Roth retirement account, you're still paying taxes on the $50,000. However, in retirement, when you go to take it out, because it's already been taxed, you'll then take it out on a tax-free basis. Continuing along here, so we know about how the taxes are treated. We know what a traditional, we know what a Roth is. We have individual types of accounts we can use, and we have accounts that are available to us through our employers. So an individual retirement account is also known as an IRA. That's something you can set up on your own. You can make your own decisions and your own choices about who you want to have manage it, what company you want to put it with, how you want to invest it, right? You make those decisions. The employer-sponsored plans, this is where we get into all those different letters and numbers, if you will. The 401k is for a company, right? A private company that you'll be working for. A 403b is through a public school and certain types of nonprofit organizations. A 457b is for state and local government agencies. And finally, the thrift savings plan, which is also known as the TSP, is for federal employees. Now, with all these types of employee-sponsored plans, in some cases, you can receive what's known as employee matching, right? So the company you're working for or the organization you're working for is going to match a percentage of what you're putting into your retirement account. There are also what's known as pensions. Pension is a defined benefit plan. So a defined benefit plan is when you get to that point being retirement, the benefit is defined for you, and it's usually a percentage of your salary that you'll be able to earn in retirement. Deferred compensation plans are for certain types of employees that will allow them to save money into a retirement account above and beyond the 401ks and the 403bs. If you are a business owner, if you own a practice, if you're in some type of side business, you can open up a retirement plan for your business, right? There's a few different types. The first being what's known as a SEP IRA. SEP stands for Simplified Employee Pension. And this allows the business to contribute to a retirement plan, right? So the business is the one who's making contributions to the plan. There's no employee contributions allowed. It's only the business that can contribute to a SEP IRA. The other type being a simple IRA. Simple stands for Savings Incentive Match Plan for employees. This type of plan allows the employee and the employer or the business to contribute, right? So you can get business contributions, you can get the employee contributions into the same plan. And then there's also what's known as the solo 401k. A solo 401k is for a self-employed individual only. That person does not have any employees at all. If there are employees, you cannot have a solo 401k. So you might be asking yourself, what's the difference between a SEP or a simple IRA and a solo 401k? Well, the main difference, one of the big differences is that in a solo 401k, you're allowed to take loans against that, right? You can take distributions against the solo 401k, whereas in an IRA, you're not allowed to take out any policy loan or any account loans. Some rules and limits surrounding retirement accounts, right? So with retirement accounts, there are some rules you have to be aware of. One of those is what's known as an early withdrawal penalty. Before the age of 59 and a half, if you want to take money out of the retirement account, there is a 10% penalty for early withdrawals. In certain situations, that penalty can be waived, and we'll get into what a couple of those are, but like, for example, disability is one of those situations. If it's taken out if you become disabled, the penalty can be waived. The required minimum distribution, which is also known as an RMD, required minimum distributions, that's the age when you have to start taking money out of retirement accounts. So currently it's at age 73. It was at 72, but it was increased to 73. At age 73, you have to start taking money out of the retirement accounts. And then there are contribution limits, the amount you can contribute in a year. So under the age of 50, if you're contributing to a 401k or 403b, one of those types, you can contribute up to $22,500, right, into the 401k. It was previously $20,500, and we saw an increase to it this year. If you're 50 or older and contributing to one of these retirement plans through your employer, there is what's known as a catch-up contribution. A catch-up contribution is for people who are 50 and older and want to put away more money to catch up for retirement planning. It allows you to put away an additional $7,500, which allows you to do a maximum of $30,000 into a employee retirement account if you're above the age of 50. IRAs, those individual accounts, the contribution limits are a little different. Currently for 2023, it's $6,500. Last year, it was $6,000. And again, there are those catch-up contributions if you're over the age of 50, which you can put away an additional $1,000. So currently, if you're over the age of 50, the maximum contribution is $7,500, which is that $6,500 plus the $1,000 catch-up contribution. All right. So now we can get into talking about the Secure Act and what that is and what changes does it bring, right? Because we've established a basis for what these retirement accounts are, right? So the Secure Act, and Secure stands for Setting Every Community Up for Retirement Enhancement. It initially came into law. It was introduced in December of 2019, and it increased the required minimum distribution from 70.5 to 72, right, which was for last year. Inherited IRAs. So an inherited IRA is if you are receiving a retirement account from somebody who has passed away, and on a retirement account, you name a beneficiary who you want the money to go to. If that person is somebody other than a spouse, right, the requirements is now that you have to use that money within 10 years, right? So in the past, it was set up a little bit differently, but starting in 2020, you had to start using that money within 10 years if it's a non-spouse, that's the beneficiary. There is a penalty-free withdrawal for parents after childbirth. So if you have a child and you need to take money out of your retirement account, you're allowed to without any penalty, up to $5,000. It also allowed for 529 education plans. So 529 is a place where you can save money for education. So the money inside of those plans can now be used towards student loan repayments. So if there's money left over, you want to use it towards student loan repayments, you can without any penalties or taxation on that. Part-time employees. So in the past, if you had a part-timer who was 1,000 hours or more, they can qualify for retirement benefits. That was actually reduced to go down to 500 hours. So if you do 500 hours or more, you can qualify for a 401k through your job. The Secure Act was with some more things were added to the Secure Act. So we call it the Secure Act 2.0, sorry. Secure Act 2.0 was signed into law by President Biden on December 29th of 2022. And it increased that required minimum distribution again. So it's going up to 73 for this year. In 10 years, it will change again. In 2033, it will be 75 years old. So those are some changes that have come because people are now working longer. There's no need to take the money out sooner. So the government is pushing back the point in terms of requiring those minimum distributions. If you do not take money out of if you do not take your required minimum distribution every year when you're at that age, there is a penalty that is assessed, right? And that penalty used to be 50%, but the Secure Act 2.0 reduces it to 25%. If you have a Roth 401k or a 403b, all right, the required minimum distribution has been eliminated, meaning that you don't have to take it out of those accounts any longer. Employee matching. So the way employee matching has worked in the past is if you have a Roth style retirement account through your employer and you're getting a match, that matched amount did not go to the Roth account. It went to a traditional type of account, right? So you had kind of this little side account with a traditional retirement account, which was the matched percentage going in. The law changed that. So now employees can contribute to the Roth account that you also have set up, which is a great change. Effective in 2 years, January of 2025, employees will automatically get enrolled into a retirement plan, which is great. You start a job, you are automatically into that account. You don't have to wait a certain period of time. You don't have to fill out paperwork and all that stuff. You are automatically enrolled. If you do have a small business and it's 50 or less employees, all right, and you start a retirement account, there will be tax credits available to you for starting that retirement account. A few more, the matching contributions, right? So if you are making student loan payments, the matching contribution from your employee can actually be that student loan amount that you are contributing, which I think is a great feature, a really cool thing. Those catch-up contributions we talked about, right? Those are going to be increased over time, starting in 2026 to take into account inflation. So we'll see increases there. If you're between the age of 60 to 63, you'll be allowed to make additional catch-up contributions to the qualified retirement plan. Qualified retirement plan means it's through your employer. And again, those 529s we talked about, one of the additions to that now is if you have money left over in a 529 plan, you save money for your kids to go to college. They didn't use up all that money. If there's money left over, you can roll it over into a Roth IRA, which is a huge benefit because a lot of times when that money's left over, you're forced to take it out if you have nobody to turn it over to. And you'll be then paying taxes and penalties on that money. So it's great that you can now roll it over into a Roth IRA. There are additional early withdrawal penalties. So that 10% before age 59 and a half, if you're terminally ill, or if you live in an area where there's, it's been declared a disaster area, you can actually withdraw from your 401k free of penalties. And finally, each state is going to be required to create a database for orphaned retirement accounts, which essentially means is if you worked at a company, you had a retirement account there, you left, you kind of forgot about that retirement account and time has gone by. There's going to be a database now to help you track down that retirement account. So ultimately you can gather your money, which is great. I haven't seen any questions come in. Are there any questions at this point that anybody has? Before I wrap up with some final thoughts here, I think we're good. So just some really final thoughts here to leave people with. Don't put off saving for retirement. Again, the earlier you can start, even at those smaller dollar amounts, is great. As a general rule of thumb, aim to save between 10 to 15% of your income each year toward retirement. Now, does that mean like you need to start there? Well, no, you can start slow and work your way up, right? So for example, let's say you start at 1 or 2% of your salary. Every 6 months, let's say, for example, you increase that. So you go from 1 to 2, then you go from 2 to 4, so on and so forth, right? That's a great way to start. So you can walk before you run. Also factor in your employer match, right? So if you want to save 10% of your income, well, if you put away 5 and your employer matches you up to 5, well, then there's 10 between what you're putting in and what the employer is matching you. It's important to review your retirement account at least on an annual basis, just to check in and see how it's doing. It's always best to review with a financial professional or a trusted advisor, somebody in your world, to help you to make those decisions based on your anticipated retirement age, right? So you want to take a look at the contribution amount. You want to take a look at like what the actual allocation is, meaning what's the difference between the stocks and the bonds and the different types of investments. And, just get some feedback there. What I will say is a lot of times I've come across individuals who are getting advice from other people who are, more or less savvy in the financial services world, but they may not be a financial services professional. All right. So that specific advice that they give you might be specific to them, which may not always be good because everybody's financial situation is a little bit different. There might be specific reasons why this person is doing that strategy. And if they're making that recommendation to you, well, does that strategy make sense based on your financial circumstances? Again, it's always best to go to a financial professional just to check some of that advice and say, my father-in-law, my brother, my sister, my friend, whomever, mentioned I should be doing this. What are your thoughts? And get some feedback, again, surrounding you as a person rather than these generalized ideas based on other circumstances. So really quickly, we'll wrap up. If anybody has any questions, I'll be here for a couple more minutes, but I encourage everybody to try and reach out, connect with me on social media. I'm on LinkedIn, I'm on Insta, I'm on Facebook. My handle, all those places, is Casella Personal Finance. Casella is spelled Casella. My website is alexcasella.com. My email is alex@alexcasella.com. And like Safi, I also offer complimentary consultations. Those consultations carry no obligation whatsoever. So you can schedule a time through my Calendly. You go directly on my calendar and schedule a time and ask whatever questions you want about your finances. At the end of the day, I'm happy to tell people about, more about our practice and the way we work with people, but there are no obligations to work with us if you want to just sit down and chat. And that's all I had today. So I appreciate everybody being here. I try to keep this within 30 minutes, and I think I've done a good job doing that. If there are no questions, then I'll pass it back to Safi, and I'll say thank you for having me today.
Thank you, Alex. That was great and perfect timing. Really good information, really basic information. I think just understanding the basics before getting too in depth with all the different rules and regulations that go around retirement planning was great, because I think some people are at square one. And so what I just want to kind of comment on a few things that you mentioned. No questions have come in yet. I think it was very thorough. If we can just close out of the share screen.
Oops, I hit the wrong button. There it is.
All right. Perfect. All right, great. So what's interesting is that in reality, we do have to plan for our own retirement, because we've heard about the whole Social Security going bankrupt, drama, whatever it is, for years now. And then the number changed, the year changes. But at the end of the day, do we want to put our livelihood in the hands of just Social Security? Because is Social Security even going to be enough if it is still here? Right.
Yep.
And that's why it's important to plan for retirement. It's also important to have multiple streams of income, so that maybe you still have some income coming in regardless of, the age that you're at as well. And so being as a business owner, what I liked is that business owner retirement plan contributions are generally higher. than employees, depending on the profit of the business, of course. So
Correct.
while there's the 401k, if your job has one, and then the regular IRAs, those are great. But if you don't have that, let's say you're fully self-employed, then you have those other options, as Alex mentioned. And with those options, you can contribute, some 50 something thousand in certain cases, depending on how much you're paying yourself if you're an employee of your company, or depending on how much profit your business has. So definitely, prepare for that, because if you're working for yourself, no one else is going to be preparing for retirement for you. And you want to understand the rules if you have employees, if you don't, so that you're compliant, right?
Right.
And
Absolutely.
so Alex, if you want to share a little bit about some of the, clients in the mental health space that you work with. I know you kind of have a focus in that area, and I'd love for you to share about that.
Yeah, absolutely. So full disclosure, my wife is a clinical social worker. So this is, when we started dating back in 2016, one of the things I learned is how little she was trained in personal finance. I mean, she had a little bit based on what her parents left her with, but in her professional training and from her colleagues, classmates, and friends, I learned that they get no training in personal finance. So I see the work that the social workers do, the mental health professionals do, first responders, crisis intervention, and you're putting a lot of time and effort into that caseload and all the work you're doing. And a lot of times you just don't have time to think about your finances. So I saw this as an opportunity to help individuals who are helping others, because at the end of the day, you're making money and you want to retire someday, and you want to make sure you're doing the right thing. So the opportunities, have been great. I've met a number of individuals in the mental health field, be it from clinical social workers, private practice owners, family, marriage and family counselors, first responders. I have social workers and certain paramedics and stuff that I work with, where again, they're just, no one's really helping them. They're plopping a employee benefits package on their desk and saying, here you go. Nobody's going through that with them. So at the end of the day, what I've been able to do with a number of people is just to kind of help create that organization. Like, let's take inventory of your stuff. What do you have? Let's put it together. Take a look at your cash flow. What's going on from a cash flow perspective? What's going on from a debt perspective? Let's manage your debt. And let's take a look at all the insurances you have and talk about why those are important. Talk about your savings, talk about ways to grow your money, and ultimately encompass all this stuff to put together plans so that you can, retire or whatever it is you're looking to do. I mean, we also get into we don't do this in-house, but we get into talking about legal planning and why that's important, because at the end of the day, something happens to you, we're going to get a phone call from somebody we've never met before because you're incapacitated. Well, what is the will saying? So we talk about a lot of different areas. We don't just focus on retirement planning, if you will. But our goal is to, again, educate people about making these financial decisions and ultimately making sure we're being holistic in that way. So I hope that helps answer your question.
Yeah, that's perfect. Thank you. Thank you for sharing. And I come across a lot of, mental health practice owners who, it's just a lot of anxiety about money. It's overwhelming. And I get it. If I had to, trade places, it would be overwhelming for me as well, for the work that you guys do. And so it's understandable, but that's why it's so key to work with a professional who knows the industry,
Yeah.
who knows the industry, who can teach you what you need to know, but also, take some things off your plate. Because what happens is the more these things are put on the back burner, the more anxiety it will cause, because it can lead to, late file tax returns because your bookkeeping isn't in order. 50, 60 years old and not knowing how to retire because it wasn't planned in your 30s and 40s and 50s. And so just as I'm sure putting these things on the back burner make it worse. And so you want to kind of wrap your head around and work with someone to figure out how you can get on track with your finances holistically, as Alex mentioned, not just for your practice, but as a whole, because your practice is going to feed into your personal life. And then if you are incapacitated and you're in private practice, well, that's your whole business, right? Or if you're running a group practice, can it run without you? And what do you have in place? God forbid something happen.
Yeah, absolutely. And, there's a client who I work with who has been a social worker for a very long time, retired, and just does some small private practice stuff on her own. she had kind of stuff all over the place, retirement accounts from old jobs, her own retirement accounts. She has accounts for her kids. And when we start to talk about why holistic planning is important, because at the end of the day, she was getting advice from a lot of different people, which was giving her conflicting advice, right? So she was getting, she had somebody from the bank that was helping her, and they opened up some accounts for her kids. What she didn't realize is there was tax consequences with those accounts that she opened for her kids. So when she wanted to give them to their kids, it caused some issues. So we get into talking about like taxation, and Safie, you're definitely a part of this. When it comes time to make a decision, like what are the tax implications, right? How is this going to impact what you're trying to do from a tax perspective? So we bring in all those different areas to ultimately kind of sit in the middle of the world with somebody and help them to make these decisions along the way.
Absolutely. And having professionals that work with one another is key. If you have, your accountant, CPA on this end and your financial advisor on that end, and no one's communicating, then you're going to have those conflicts. And then there's also the legal aspect, which is important in some cases too. So it is important to have a cohesive team, finance, legal, accounting as well. Yeah. So no questions have come in. I want to just take a quick note, comment, look at my notes, because I learned a few things here, especially with all the new changes, because keeping up with these law changes, it's a bit much. But what I found interesting was the RMD, where the Roth, you're no longer required to take an RMD, because I have clients where we talk about the tax impact of Roth versus traditional, and where you're going to be now versus where you're going to be later income wise. But then this is another factor. Well, what if you don't have to withdraw it, and it can be passed on, I'm assuming, right? It can be part of your beneficiary can then take that income, and you may be subject to the 10-year rule, if they're not a spouse. But, what if there's a way to build this up and then the tax impact doesn't affect you at all? That's a big deal.
Yeah, absolutely. I mean, we talk a lot again about taxes, and it's not just taxes today. Like, okay, that's important, but what about taxes then? When we get to retirement, we don't know what tax laws are going to look like.
Right.
Based on where we're at right now, it's possible that tax rates will increase. And people think, well, I'm going to be in a lower tax bracket. Not always the case when you get into retirement. I mean, I know, like from my experience, just seeing, kind of grandparents, we have an 18-month-old. So seeing like other grandparents, they're spending money. They want to go on trips, and they want to spend money on the grandkids, and they have their taxes and their own bills to pay. It's not always the case that you end up in a lower tax bracket, So that is a big part of, planning. Roth retirement accounts definitely provide that tax-free income. There are other ways to establish tax-free income too. And I don't want to get too into the weeds of like how those work, but there's other ways to establish tax-free income in retirement as well. So yeah, it's super important to everybody thinks like, I'm just going to put all my money into my retirement account, my IRA or my 401k. That's fine. But at the end of the day, you're putting all your eggs in one basket. So that one basket has rules associated with taxation. It has rules associated about when you can use it, rules about how you're going to grow it, whatever the case, so on and so forth. So it's important to kind of diversify about how you're accessing your money, how you're holding your money against all those different things.
Great point. Great point. Perfect. All right, guys. So we're going to go ahead and wrap it up before I start diving in too deep into the woods here.
I know, right?
Because we can definitely go on and both be passionate about finances. But I definitely encourage you all to ensure that you are in communication with your professionals, finance, accounting, legal, and make the investment upfront so that it's not so much a burden later on. And so we're going to go ahead and wrap up. I'm not seeing any questions. Great, thorough session. So Alex, if you can just share one more time, if anyone came in late, how people can contact you, and then I'll wrap up.
Yeah, sounds great. Thanks again, Alex Casella. My Instagram, Facebook handles are Casella Personal Finance. My website is alexcasella.com. On there, you can find a link to my calendar, and I offer complimentary consultations, no obligations to do business if you just want to sit down and chat. And thank you again. I really appreciate it. Everybody have a great weekend.
Thank you, Alex. Thanks again for taking the time with us today. Again, Safie Russell, founder and CEO of SDR Consulting Inc. And here at SDR Consulting, I provide tax, accounting, and business consulting services for business owners, especially those in the mental health profession. On social media, you can find me at Safie Russell CPA. Website, sdrconsultinginc.com. And thank you for sharing that. It was a great event, getting some feedback here. And then lastly, if you want to schedule a introductory call, you can reach my office at 516-255-6603. All right, everyone, have a great weekend. Make sure you do something for yourself this weekend. And we will be back. Stay tuned Fridays, 12 o'clock Eastern for Business Basics Friday. If you're catching this, and you're not in my Facebook group where the announcements go out, make sure you search for the group SDR's Tax Tips. And you can also watch prior episodes here on Facebook, the main Facebook page, or on my YouTube channel at SDR Consulting. All right, everyone have a great weekend. Alex, have a good time. Great weekend
Thanks, you
as
too,
well. And
Safie.
thanks
Bye bye,
again.
everybody. Bye bye.
Take care. Bye-bye.